Welcome everybody to the Chart Book, episode 4. Today I have a co-host. What's your name, son?
Anton.
Anton Faber. This is my boy. He just gave me his hat. Hands down the best dad ever. Anton, you know what dad does for work? No, what do you want to be when you grow up?
Baseball player.
That's pretty cool. Do you like my background?
Yeah.
This is space. That's what the Earth looks like. You know what all those lights are?
No.
Trick question. They're all lights because it's at night. You want to show everybody what you're wearing today?
Yeah.
Pajamas?
Paw Patrol.
Pretty cool. All right. Do you want to say goodbye, everybody?
Goodbye, everybody.
Goodbye, everybody. All right, on to the charts now. Thanks to Anton for all your help, buddy. Unless you think I have too much of a big head from being the world's greatest dad, you guys can see that what my wife thinks about me, the world's okayest husband. So we're going to hop over now. We got lots of charts. By the way, if you guys have charts, send them over. We'll include them in the show. Feedback at themebfabershow.com. We like the user-generated ideas, too. First up is we got a tweet from Michael Batnick over at Animal Spirits and Ritholtz Crowd. And if you've been watching markets lately, you know that there's been a lot going on the past 6 months. The first quarter of the year had the fastest bear market ever from all-time highs. And hopefully people behave, but had a plan going into it. We talked about this a lot in our articles, Stay Rich, Get Rich portfolios, and of course, how I invest my money, but most importantly, investing during the time of Corona, and said the most important thing is to have a plan. And if you don't have a plan, look what happens. This is a stat from Fidelity that showed nearly a third of investors in a particular cohort, the one that's probably couldn't afford it, late 60s, sold all of their stocks in February and May. And the article from the Journal goes on to detail that it was something like 20% of all investors did it, which is terrible. And of course, we know what happens next, right? Is investors say panic at the worst possible time, and then the professor, arguably my favorite professor, Damodaran, he's been on the podcast, this old episode, go check it out, detailed that guess what? Right after that, stocks had the best 50-day run in history. And he said, seemingly disconnected from unrelentingly bad macro news, and that is driving people into a frenzy. When your narrative for the economy clashes with that of the market, humility is the best option, which is great advice. So all those people, look, they sold at the worst time. If you can say one of the reasons that people, are thinking about what's going on in the markets is they don't have a whole lot else to focus on. This is kind of a joking tweet, but I think it's actually fairly prescient, which is Travis Kling says, the NBA is going to start playing games in July. If you don't understand why that's bearish for stocks, you don't understand what's been going on. I love that Colorado has started allowing sports gambling, and the number one most bet event the day they launched was Russian table tennis. And so we'll probably talk about education and what's going on next week in the show, but certainly people have been speculating. But it's weird because Damodaran talks about there has been this big disconnect between what's going on in Wall Street and the Main Street. And here's an example. A lot of companies, this is Chapter 11 filings, businesses with over $50 million in liabilities. It's getting as bad as the global financial crisis. And then you have, this is a popular tweet of mine where I said, look, putting it in simple terms, over the past 12 months, if I told you, crystal ball, go back a year, unemployment would jump from 4 to mid-teens. Fed interest rates basically go from 2.5 to 0. Economic indicators like PMI would go from expansionary to contraction. Gold is up a third. Volatility is up by 40%, if not more. Stock valuations, both entering and exit at one of the highest deciles in history. But, oh, by the way, there was a pandemic. S&P is going to be up 14%. Most people would not have bet that. They would have said down 20, 40, 60, 80. And so it's this very weird dissonance between what's going on in the world and what stocks are doing. And, Jesse Felder has a nice chart from John Hussman, who I think a lot of people mischaracterize as a perma-bear, but he has a nice breakout of market valuations based on size. And what you can see in this chart is the purple line is the 10% largest by market cap companies in the stock market. The green is the median and the red is the smallest. And what you can see is the big stuff is getting as expensive. This is price to revenue, but you can use almost any metric. They say similar things. As almost expensive as it was during the dot-com bubble. The median stock is actually more expensive. And then the smallest companies absolutely got destroyed in Q1. So you saw small cap stocks, in particular value, at one point go down by half. So it's created a bit of a spread between the big and the little. And you can see it in other areas too. Here's Jeff Weiniger, where he was showing the largest stocks within the stock market and how they compare to the rest of the world. And under this metric, it's actually the highest it's ever been compared to non-US markets. And other examples, this is a nice chart from Vitaly from Cisco back in '99, and trying to make the disconnect and saying, look, you can have a great company. Cisco is a great company in '99, still a great company, but the stock got way ahead of itself, and you've had 20 years of dead money going on for one of the largest stocks in the stock market at the time. And if you guys remember back, by the way, is that the biggest problem with market cap weighting is it will expose you to these periods of booms. So you have times, because there is no fundamental anchor to valuation whatsoever, that often in times of booms, the biggest stocks end up being some of the most expensive. And so you can, as long as you disconnect that tie towards just size, and you can do almost any other weighting methodology. We joked on Twitter talking about doing a random dart throwing fund, but anything else, we prefer valuation, of course, but momentum, equal weight, whether CEOs wear bow ties or ties, doesn't matter. As long as you break that market cap weight, adds a couple percentage points per year in almost every market sector, country, all around through history. I say almost, I actually don't know of any that don't, but I'm so used to saying with public funds, you can never guarantee, but at least in history, market cap has been suboptimal. But it's interesting because this has caused behavior of everyone wanting market cap and growth that Michael Venuto has a tweet that says the majority of investors for most of the past decade plus believe value beats growth. But sure enough, once you have this massive run by growth, nobody wants value anymore. So it's setting up the stage, I think, for a decade of strong value returns, not just within the U.S., but abroad. We'll get to that in a minute. We got Jeff back. 2 tweets from Jeff this week. And he said similar results with PE ratios. If you look historically, the expensive and the cheap almost always wins, but it doesn't always win. Otherwise, everyone would do it all the time. There's times when it massively underperforms. So you have examples of this past decade, and the last time it happened was the 1990s. So there's times when value gets beaten, which sets up. Now, people could say, well, why not just go short the expensive stuff? I know it's crazy. It'll go down eventually. You know, the challenge with shorting is not just the stock does a face ripper. If you're short a stock at 50 and it goes to 100, you probably lost all your money. So position sizing is important. Timing is important. Even if it's a bankrupt fraud, you got to usually have a catalyst. And on top of that is you have to pay to short these. Remember, people have to lend you the stock. And so the problem, this is with the new electric pickup truck, which has no revenues and no pickups. And this talks about how you actually have to borrow the stock, and the cost to borrow the stock currently is a 600% fee. So meaning you need the stock to go down 50% this month just to break even. And I think a lot of people don't realize that one of the biggest headwinds on shorting is you actually have to pay up. Now, the flip side of that, which is kind of nice, is that if you're a long fund that owns securities that people want to short, you can lend those out. And we talk about this with funds like ETFs all the time, and people don't usually know this, including advisors, that most of the good fund complexes like ours, you'll take that short lending revenue and return it to the fund shareholders. And in certain areas that are highly shorted, think cannabis, biotech, semiconductors over time, that short lending revenue can be very material. It could be 10 basis points, it could be 50. In some cases, it could be hundreds of basis points, meaning multiple percentage points of income for the investor. So you could have a fund that charges, say, 0.5%, but have 200 basis points, 2 percentage points of income, meaning not only is that fund technically, the way I think about it, free, you're actually getting paid 1.5% to own it. And there's a lot of ETFs like that. You can Google some stuff from BlackRock or Vanguard or State Street that'll tell you about short lending programs. So it's actually good for the long holders as well. And not a lot of people know that. So the global market portfolio, for all intents and purposes, is probably already free, if not negative. What a world, 2020, to own funds that pay you. Meanwhile, the average mutual fund out there is still 1.25%. So put it in context. People don't know about this. They very willingly pay high fees when they don't need to. Anyway, we updated this chart. We'll do it at the end of the quarter. We'll do a valuation-focused chart book. But this goes to show the U.S. versus the world ex-U.S. versus the cheapest quartile of countries. And, everyone, I've talked about this ad nauseum, so I'm not going to drone on too much about it, but everyone loves talking about how the U.S. deserves to be more expensive, has all these advantages, stable geopolitics, which I laugh at, rule of law, yada, yada. Okay, and maybe there is some deserved premium, but I say, if there is a premium, what do you think it should be historically? And people come up with 10%, 20%, 50%. And it turns out, if you go back to the 80s, the U.S. has had zero historical valuation premium. It's just that it's had a valuation premium since 2009. As the market's ripped right up from the financial crisis, you see these alligator jaws of the U.S. having a rocking and rolling 2010s. Most of that came from multiple expansion, whereas the rest of the world has been flat, including the cheap stuff. Now, we wrote articles calling this the biggest valuation spread in 40 years. If you look back earlier in this chart to the 80s, of course, you had Japan being the big bubble when it was really expensive, but the U.S. and the rest of the world was pretty cheap. So a big opportunity to de-dollarize right now, get exposure to the rest of the world. As you know, half the market cap is outside the U.S. A lot of people don't know that. So the starting point should be half of your stock should be abroad. And then if you're valuation focused, it should be even more. That's uncomfortable for a lot of people. We track a lot of long-term valuation metrics. That was a 10-year PE. And as an example, the U.S. is creeping. I think it's up around 30 now. This is the beginning of June. The average developed country is only 18. Totally reasonable. That's about average over time for low inflationary periods. That's actually cheap. Average emerging market country is 12. So we're talking a straight up less than 50% discount to U.S. And you go back to some of my older tweets that talk about all the positive tailwinds of emerging markets, and you could argue that it should even be traded in parallel, if not a premium to the U.S. And the cheapest bucket is straight up single digits. I'll let you guys have to guess which flags these are. These are the 5 cheapest markets as of, I believe, the end of May, and the 5 most expensive. And you see U.S. in the most expensive bucket. Almost universally, by the way, the cheapest buckets, the PE is single digits because the P has gone down, meaning stock market is already down 40, 60, 80%. And the expensive stuff is just the P has gone up. It's hitting all-time highs, so it's getting expensive, if not at all-time highs. So this was actually a reader submission from Rabbi Jacob, and he was asking about, talk about this chart, which is showing that this disconnect between one sector, particularly U.S. tech, versus the rest of the world tech. And you can see a tiny discrepancy in 2000, but then this just absolute monster run tech has had over the past decade. Probably a lot of it justified. But you got to remember this distinction, we go back to Cisco, between a business and a stock. You can have the world's best business and the stock can be cheap, or it can be expensive, or it can be fairly valued. You can have the world's crappiest business, and same thing. You always have to put it in context and remember that valuation is important. So a lot of people love to talk about sectors and how the U.S. versus the rest of the world has a slightly different sector composition. Most of the research I've seen has shown that, yes, that does have an impact, but it's actually pretty minor. This is a nice chart from Top Down Charts that shows the differences between sectors and how things play out. Click through to take a look at it later. We're not going to spend a lot of time on it. But the bigger point to this also, by the way, is that anytime you pick an index or an approach, let's say you're going to use a global valuation approach, you could say, hey, I'm going to pick countries, and then you pick the cheapest countries. Or you could say, and that's called top down, or you could say, I'm going to pick bottom up. So I'm just going to choose all the stocks in the world and pick the cheapest stocks. Both those are totally valid and probably will actually have a very similar return. But the difference is that they introduce a little bit of bias in both decisions. By selecting countries, you're going to bias towards smaller countries. So if you pick a country like Czech, Republic that has, only a dozen or 2 dozen stocks that are of sufficient size versus Japan, which has thousands, you're going to bias towards smaller countries. Vice versa, if you go bottom up, obviously you're going to end up with usually more Japanese stocks than Czech because Japan has thousands of choices, much more breadth than Czech Republic does. So neither approach is wrong, and I think they're both totally going to be highly correlated and similar, but just notice your biases as you go into these things. What else is going on in the world? This is a chart about CalPERS deciding to leverage their portfolio, and it totally got ratioed on Twitter. I think CalPERS had publicly disclosed that they liquidating most of their tail risk funds and strategies directly before the crisis was probably not a good look. They've been in the news a lot. There's two separate parts to this. The first part is, should CalPERS be leveraging their portfolio at all? And I'm roughly agnostic. And the reason being is a lot of asset classes are leveraged already. Real estate has debt, stocks have debt. And so whether you pick a portfolio that has prepackaged leverage, Bridgewater talks a lot about this, Ray Dalio. So there's no reason to accept an asset class the way it's given to you. You can leverage and deleverage anything in the world. If you don't like stocks, but you want stock exposure, you can have 50% in stocks and 50% in cash, and that'll give you a similar return profile, but with usually half the the deleveraging, so lower return, lower risk sort of equity curve. Same thing, you can leverage up 2-to-1, 3-to-1, whatever. The bigger problem is, does CalPERS need to be using leverage at all? And so many of these real money institutions in 2008 got into so much trouble holding a bunch of illiquid crap they couldn't get out of. And on top of that, they had a 50% drawdown. Now, you don't see it because they usually only mark to market once a year, but liquid portfolio comparisons mean they lost half. And the problem with so many of these big money institutions, endowments, is they have a lot of competing interests. Think of Harvard. They have students, they have future students, they have faculty, they have employees, they have alumni. They all have different vested interests. And so when you have something that loses 50%, people start to lose their mind. So can CalPERS sustain that? I don't know, maybe. But adding leverage, even the sound of it, a lot of people like Buffett talk about this, and he's just like, look, you don't need it. So anyway, but the bigger problem with CalPERS that we talk about is that, we've done a whole series, this is back from 2015, on big money institutions, and we write them, we said, should CalPERS be managed by a robot? Should Harvard be using a robot to manage their portfolio? And we walk through the historical returns. In this case, this is CalPERS. We show that there are 3 portfolios from our book, Global Asset Allocation, which is free to download, by the way. And GAA is the global market portfolio, so half stocks, half bonds, half U.S., half foreign. The Aryan is the endowment style portfolio from the book. And here's CalPERS. You can show they essentially have the same return. So CalPERS could likely just liquidate their entire staff of thousands of employees, hundreds of millions of dollars probably in costs, if not billions, the complexity, the effort, the headache, and just buy a bunch of ETFs and end up in the same place. Not a lot of big money institutions are willing to do that yet. I think you will see more in the future as more and more pressure becomes on transparency and all the issues that go along with these real money institutions. Now, plenty have done an incredible job. Harvard and Yale over time have absolutely stomped the investable benchmarks. Will those inefficiencies occur in the future? Will someone like Swinson, how long of a leash does he have of outperformance? And I think if you have a community and a culture that buys in like Yale does, God bless you. That's awesome. Most institutions aren't Yale, though. And so it'll be interesting to see how a zero cost, in the world we live in, no effort robotic portfolio compares to these institutions going forward. Let's check back 2030 on the podcast. Ashby, who we've had on the podcast for, is a great writer. He does a lot of research into ideas. He's co-founder of a company that does savings-based, lottery-based savings. We'll talk about maybe in the next episode. But he just kind of totally destroys private equity here. He says basically its entire benefit is to print billionaires that are the GPs and paid for by your local pension fund. And here's the paper on SSRN. You can go download. you'll go down a rabbit hole in SSRN. We got a lot of papers on there. We actually wrote a new paper. We'll talk about it maybe in the next week's chart book. It's called, it's pretty timely. We actually wrote it last year, so some of you may maybe seen it already. But it walks through an example of people as the U.S. stock market was hitting new highs. Is it a good idea to buy stock markets at all-time highs? And the name of the paper, which will give away part of the conclusion, was, are all-time highs a good time to invest? No. They're a great time. And this is a little bit different because I don't know anyone that agrees with me other than my crazy trend follower buddies about this topic. But check it out. We'll talk about it next week as well. All right, we're going to do a couple random things and we'll start to close this down. Here's one of my favorite stories of the past 10 years, maybe ever, was this art dealer in New Mexico filled a bronze chest with gold, jewels, and valuables worth more than $1 million, hid it in the Rocky Mountains a decade ago, wrote a poem and wrote a book, gave some hints on where to find it, a lot of media coverage. And his goal is, hey, look, I just want to get people out in nature. And thousands, if not tens of thousands of people, if not 100,000 people, were searching all over the Rocky Mountains for this chest. Some people said he was a fraud. Some people said he didn't do it. A couple people actually died in the search. I love the story. I think it's fantastic. I'm going to spend part of this summer in those same woods. But someone found it, and they proved it, and he disclosed, yes, someone actually did find it. So kudos to them. See if they report it to the IRS. Here's another funny tweet from probably a random Twitter troll account, but he says, I work at McDonald's, and I give every burger a small kiss before I send it out. Oh, this is an awesome story. Victor Vescovo, if you don't know who that is, Google him. He's literally the world's most interesting man. Lost in the pandemic and all of our social struggles right now going on in our country and around the world. You have some positive news, too. Some massive scientific progress. We're getting rockets, commercial rockets, back to the space station and hopefully onto some new planets soon. And on the other side, he did the longest, deepest dive ever. And he's been 4 hours, 7 minutes, 2 miles down. They even took Baby Yoda. By the way, if you know Victor, he wants to come on the podcast, hit him up. We'd love to have him on, chat about it. Bal Kunis here representing with something I haven't seen in probably 30 years. A bunch of vintage NFL pencils off eBay. I don't see any Broncos on there, though. I'm going to have to grab a few of those. Jason Zweig, of course, arguably my favorite reporter out here with a story that is unbelievable, really. And the last person to receive a Civil War era pension, Irene Triplett, just died. Her father was in the Union Army, and she collected $73. How crazy is that? It also goes to show how short our history in the U.S. particularly has been, but also around the world too. We're going to let you go with a little Yo-Yo Ma. He puts these home concerts on. Take a listen. We'll give you a minute or two and then wind down.
But then you came and took my song, took my song, took my song. But then you came and took my song, claimed it for your own. I took my bucket, lowered it down, lowered it down.
All right, everybody. Great episode. Send us feedback at themedfabershow.com. I'd love to see some new charts, some new tweets we'll include next week. Stay safe, everybody.
Matt Faber is the co-founder and chief investment officer at Cambria Investment Management. Due to industry regulations, he will not discuss any of Cambria's funds on this podcast. All opinions expressed by podcast participants are solely their own opinions and do not reflect the opinion of Cambria Investment Management or its affiliates. For more information, visit CambriaInvestments.com.